Ladies and gentlemen, Vault Zero here, and I need you to stop scrolling right now because what just happened in the housing market is not what they are telling you on the news. It is Sunday, January 11th, 2026 in the United States, and 48 hours ago, President Trump dropped an order that sent shockwaves through Wall Street, even though Main Street is celebrating. He ordered Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds. Within hours, 30-year mortgage rates crashed below 6% for the first time in nearly 3 years. Real estate agents are popping bottles, homebuyers are flooding open houses, and every financial headline is screaming that this is your chance to lock in cheap money before it is gone. But here's what nobody is saying out loud. When a president has to force two government-backed mortgage giants to inject $200 billion into the bond market just to keep rates from exploding, that is not a sign of strength. That is a red flag the size of Texas. Let me show you exactly what is happening right now, who's about to get crushed, and why this so-called win for homebuyers might be the last gasp before the housing market rolls over. If you have been watching mortgage rates, you know they have been stuck in the high 6s and low 7s for most of the past 2 years. The Fed raised rates, inflation stayed hot, and banks were not lending unless you had perfect credit and a massive down payment. Housing was frozen. Then on January 8th, Trump posted on social media that he was directing his representatives to have Fannie and Freddie buy up to $200 billion in mortgage-backed securities. He said this would lower rates, reduce monthly payments, and make homeownership affordable again. Within 24 hours, the average 30-year fixed-rate mortgage dropped from 6.23% to 5.99%, according to Mortgage News Daily. That is a 22 basis point crash in one day. Homebuyers who were on the fence suddenly rushed back in because a drop from 6.2% to 6% saves you over $100 a month on a $350,000 loan. That adds up fast. So on the surface, this looks like a massive win for regular Americans. Cheaper loans, more buyers, housing market saved. But let me explain what this order actually means in plain English, because this is where the trap door opens. Fannie Mae and Freddie Mac do not lend you money directly. They buy mortgages from banks after you close your loan. The bank sells your mortgage to Fannie or Freddie, who then bundle it with thousands of other mortgages and turn it into a bond that investors buy. This process is called securitization, and it is what keeps money flowing through the housing system. When Fannie and Freddie are aggressive buyers of these mortgage bonds, demand goes up, bond prices rise, and yields fall. When yields fall, mortgage rates fall because rates are directly tied to bond yields. That is Econ 101. But here's the problem. For the last 2 years, Fannie and Freddie have been sitting on the sidelines. They were not buying aggressively because their job was to shrink their balance sheets and prepare for a possible return to private ownership through stock offerings. That was the plan. Now, Trump just ripped up that plan and turned them back into government-controlled bond-buying machines. He is forcing them to absorb $200 billion of mortgage debt whether they want to or not. And according to experts at the Urban Institute, this pushes them dangerously close to their legal limit of $450 billion in retained mortgage holdings. That means they are being maxed out. They are being turned into the buyer of last resort, which is exactly the role they played before the 2008 financial crisis when they nearly went bankrupt. Does that sound familiar? It should, because when you force two entities to buy assets that private investors do not want, you are not fixing the market, you are rigging it. But here is what really tells you this is desperation and not confidence. If the housing market was healthy, private investors would be buying these mortgage bonds on their own. Pension funds, hedge funds, and foreign buyers would step in and say, we want that yield, we trust those borrowers. They are not doing that. Private demand for mortgage-backed securities has been weak for months. That is why the spread between treasury yields and mortgage rates, called the mortgage spread, has been abnormally wide. Normally that spread is around 1.8%. Recently it has been closer to 2.5% or higher. That extra cost gets passed directly to you as a higher mortgage rate. Trump's order is an attempt to close that spread by forcing government entities to step in and replace the missing private buyers. In other words, the free market does not want these bonds at current prices, so the government is stepping in to prop up the market artificially. That is not capitalism, that is central planning. And anytime you see central planning in a $200 billion market, you should ask yourself who benefits and who gets stuck holding the bag. In the next part, I'm going to show you exactly who wins from this order, why Wall Street banks are quietly panicking even as they smile for the cameras, and what happens when Fannie and Freddie hit their legal limit and cannot buy anymore. Now, let's talk about who actually wins from this $200 billion move, because I promise you it is not just the home buyer trying to refinance their 3-bedroom ranch in Ohio. The first group that benefits massively from this order is the banks. Think about it this way. For the past year, banks have been sitting on billions of dollars in mortgage loans that they could not sell easily because private investors were demanding higher yields than borrowers could afford. Banks were stuck holding these mortgages on their balance sheets, which ties up capital and creates risk. Now, Trump just solved their problem with the stroke of a pen. Fannie and Freddie are being ordered to buy up to $200 billion of these bonds, which means banks can finally offload mortgages they have been desperate to get rid of. They make their profit, they clear their books, and they get ready to make more loans knowing the government will buy those too. This is a direct bailout for bank balance sheets disguised as help for homebuyers. The second group that wins is anyone who already owns a home and wants to refinance. If you bought a house 2 years ago at 7% and you can now refinance at 5.99%, you just saved serious money every month. That is real cash back in your pocket, and I'm not going to pretend that is not a good thing for those families. But here is the catch. If you are trying to buy a home right now, not refinance, but actually purchase, you are walking into a market where prices have not come down, but demand just got artificially pumped up. Lower rates do not magically create more houses. We still have a massive housing shortage in America. According to Freddie Mac's own data, the United States is short roughly 3.8 million homes compared to what the population needs. When you drop rates and flood the market with cheap money, you do not fix the supply problem, you make the bidding war worse. Sellers see more buyers competing and they raise their asking prices. So yes, your monthly payment might be lower because of the rate drop, but the purchase price you pay could be 5 or 10% higher than it was 3 months ago. You win on the rate, you lose on the price, and in the long run, the price matters more because you are stuck with that number for 30 years. Now let's talk about the group that is quietly freaking out right now, and that is the bond market pros, the people who trade mortgage-backed securities for a living. Here is why they are nervous. When Fannie and Freddie step in as the dominant buyer, they distort price discovery. Price discovery is the process where buyers and sellers in a free market figure out what an asset is really worth. But if the government is buying everything regardless of price, then the market price becomes fake. It is not based on risk, it is based on politics. That makes it impossible for private investors to know what these bonds are actually worth. So they step back, they stop bidding, and they wait to see what happens next. That creates a dangerous situation where the entire mortgage market becomes dependent on Fannie and Freddie continuing to buy. If they ever stop, if they hit their legal limit, or if a future administration reverses this policy, the private market is not going to magically step back in at the same prices. They will demand much higher yields to compensate for the risk, and that means mortgage rates could spike violently. You could see rates jump from 6% back to 7 or even 8% in a matter of weeks if the support gets pulled. And here's the scariest part that almost nobody's talking about. Fannie and Freddie are not normal companies. They are government-sponsored enterprises, which means they have an implicit government guarantee, but they are not technically part of the federal budget. They were taken over by the government during the 2008 crisis, and they have been in conservatorship ever since. The plan for years was to eventually privatize them, to issue stock, to let them operate like normal companies again. By ordering them to buy $200 billion in bonds right now, Trump just killed that plan. No private investor is going to buy stock in a company that the White House can order around like a puppet whenever it wants to manipulate interest rates. The stock offering that was supposed to happen is now dead in the water, according to analysts at Bloomberg. That means Fannie and Freddie stay under government control indefinitely, which means the housing market stays under government control indefinitely. That is not a free market, that is a command economy, and command economies always end the same way. They work great in the short term. They make everyone feel good, and then they collapse when reality catches up. So what happens next? Right now, we are in the honeymoon phase. Rates are down, buyers are excited, the headlines are positive, but Trump's order gave Fannie and Freddie the authority to buy up to $200 billion, not the requirement to buy it all at once. That means they could slow down or stop buying at any time if market conditions change or if they hit regulatory limits. The moment the buying slows, rates will start creeping back up. And when rates go back up after people have been conditioned to expect cheap money, that is when the real pain starts. Buyers who stretched to afford a house at 6% suddenly cannot afford it at 7%. Sellers who listed their homes expecting a bidding war find themselves stuck with no offers. The whole cycle reverses in a hurry. In the final part, I'm going to show you exactly what this means for your money, whether you should rush to buy or refinance right now, and what the smart players are doing while everyone else is celebrating cheap rates. So now we get to the part that actually matters to you and your money, and that is, what do you do right now with this information? Should you rush out and buy a house because rates are at 5.99%? Should you refinance your existing mortgage? Should you sit on the sidelines and wait for this whole thing to blow up? Let me walk you through the smart play for each situation because the answer is not the same for everyone. If you already own a home and you have a mortgage rate above 6.5%, this is a no-brainer opportunity. You should be calling lenders right now to get refinance quotes. A drop from 7% to 6% on a $300,000 loan saves you about $200 a month. That is $2,400 a year back in your pocket. Over the life of a 30-year loan, that is over $70,000 in savings. Even after closing costs, which usually run 2 to 3% of the loan amount, you break even in less than 2 years, and then it is pure profit after that. So if you are in this camp, move fast, because these rates might not last. Fannie and Freddie can only buy so much before they hit their limits, and when the buying stops, rates are going to snap back up. You have a window of maybe 30 to 60 days to lock this in before the market shifts again. Do not overthink it, just do the math and pull the trigger if the numbers work. Now, if you are trying to buy your first home or upgrade to a bigger house, this is where things get tricky. Yes, rates are lower, but remember what I said in part 2. Lower rates do not create more houses, they just create more competition for the same limited supply. Right now, inventory in most major metro areas is still near historic lows. In cities like Austin, Phoenix, and Charlotte, the months of supply sitting on the market is under 2 months, which means homes are flying off the shelf. When you combine low supply with artificially cheap financing, you get bidding wars. You get sellers raising their asking prices by $10,000 or $20,000 because they know buyers can afford it with the lower rate. So you might save $100 a month on your mortgage payment, but you are paying $15,000 more for the house. That is not a win. That is a shell game. My advice for buyers right now is be extremely careful about overpaying just because you can afford the monthly payment. Do not fall into the trap of thinking that if the bank approves you for $500,000, you should spend $500,000. Banks do not care if you are house poor, they just care that you can make the minimum payment. You need to run your own numbers and ask yourself if this house is worth the price in a world where rates could be 7% again in 12 months. Because if rates go back up, home prices are going to come down, and you do not want to be the person who bought at the peak of this artificial sugar high. Wait for the frenzy to cool off a little bit, be patient, and do not let FOMO push you into a bad deal. Now, let's talk about what the big money is doing right now, because that always tells you more than what the headlines say. According to data from the Mortgage Bankers Association, refinance applications spiked 32% in the week after Trump's announcement. That makes sense. People are locking in savings. But purchase applications, the number of people actually buying homes, only went up 4%. That gap tells you everything. Homeowners are being smart in refinancing, but serious buyers, the ones who understand the market, are not rushing in yet. They see the same trap I am showing you. They know that when the government steps in to manipulate prices, the smart move is to wait and see what happens when the manipulation stops. Another signal that the pros are nervous is what is happening in the stock market for home builder companies. You would think that lower mortgage rates would send home builder stocks through the roof because more buyers means more demand for new construction. But if you look at the stocks for companies like D.R. Horton, Lennar, and Polt Group, they barely moved after the announcement. Some even dropped. Why? Because Wall Street knows this is not sustainable. They know Fannie and Freddie are being maxed out, and they know that when this buying program ends, the bottom could fall out fast. The smart institutional money is not celebrating, they are hedging. So here is my final take on this whole $200 billion mortgage bomb. In the short term, it is real relief for people who can refinance and lower their payments. That is a genuine win, and you should take advantage of it if you qualify. But in the big picture, this is not a solution, it is a delay. The housing market has deep structural problems. We do not have enough homes, construction costs are still high, and wages have not kept up with prices. Artificially lowering mortgage rates does not fix any of those things. It just kicks the can down the road and makes the eventual correction even more painful. When Fannie and Freddie stop buying, when private investors demand higher returns, when the next recession hits and people start losing jobs, all of these loans that got made at artificially low rates are going to be tested. And history shows us what happens when you flood a market with cheap credit and then pull it away. You get foreclosures, you get forced to sales, you get a crash. That does not mean it happens tomorrow or even this year. But it does mean you need to be smart about how much debt you take on and what price you pay for a house during this window. Do not assume rates will stay low forever. Do not assume home prices only go up. And do not let a politician's promise of cheap money override your own financial discipline. If you are refinancing, do it now and enjoy the savings. If you're buying, be patient, be picky, and do not overpay just because everyone else is panicking into the market. And if you're sitting on cash waiting for a better opportunity, keep waiting. This movie has a few more scenes to play out before we get to the real climax. The $200 billion mortgage bomb is ticking and the smart money knows it. Make sure you're on the right side when it goes off. This is Vault Zero. Stay sharp, stay informed, and I will see you in the next one.